Thought I almost just cracked my tooth on a popcorn kernel. But I think I'm alright. Good afternoon, everybody. I am an associated member of... No, not right now. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Look at that, 10 positions. When's the last time I only had 10 positions on? Can't remember. I got out of SMH today. I got out of RGTI. I got out of QBTS. They both got to my targets or extended the downside. I thought there was one other one. I remember day traded a whole bunch of names. But yeah, you know, a little bit lighter. Feels good, honestly. Feels pretty good. All right, so the market got wrecked. SPYs are down a 1.5%. Did we just bounce pretty big since the close? We're up over $1. Am I reading that right? So SPYs are down 1.5%, but that's after bouncing $1. So it was even worse than a 1.5% down move. Qs are off 1.9%, but they're also trading up $1 after hours. So I think the Qs were closer to 2% or a little bit worse on the downside. And IWM also popping a little bit after hours, but still not great. 2.6% to the downside. How did crypto close? Bitcoin down 3%. New lows on that daily chart. Looks like it's setting up for bear flag continuation. Ethereum 6.7% to the downside, right back into the support of the bear flag that it's been building. Solana down 7.5% today, also broke through support of its bear flag and is continuing to work its way down. That stuff looks terrible. Turning things over to the charts, let's start with big picture before we go to small picture. So, you know, coming into today, a little bit mixed signals, right? The SPYs were bullish. We described them in the morning meeting. The Qs were like neutral bullish. We described them in the morning meeting. And the IWM was neutral, as we described it in the morning meeting. So a little bit of a mixed signal, but generally speaking, things are bullish. The flow of funds are bullish. Things are supportive. And I still, at this point, am expecting bigger picture dips in this market to kind of be bought into the end of the year, just because there's a lot of supportive structure. And in fact, speaking of which, if we had a flat day today, we would have had an additional little bid come in from vol control. And also, into a down move, there was less selling from vol control than there would have been otherwise. Just probably has something to do with what we were rolling off on the look back. Yet even with the supportive flows that are coming from the corporate buyback, the fact that the asymmetric risk from vol control, while still existing today, was not as bad. You know, pretty notable sell down. And did we trigger through? No, I don't think so. Someone remind me that the Goldman Sachs short-term trigger for SPX is still sitting at 6,700 or so, I think. So we haven't triggered that either. So who sold? Who sold? Obviously, vol control sold if we were down, whatever I just said, you know, 2% or something. They ended up selling a little bit, but, you know, it's still not the CTAs. Corporate buyback bid is still there. Thank you, Bill, 6705. So, you know, the selling must have come in maybe from retail to some degree today. Some continuation of selling from the long short funds, maybe a little bit today. But it's interesting. Maybe these Qs are giving us a lower high on the daily chart that would only be confirmed if they broke through $600 on the downside. So it's really interesting price action today. You know, we have described all these reasons why the market should go down, right? I've identified like the 4.5 reasons that I keep harping on over and over and over again. And then if you read the latest Scott Rubner note, which, you know, we basically went over it as a team, I think just yesterday, he had even more reasons than me. He had probably 10 reasons listed on the why we should go down. Yet the why we should go down, it's so hard to be short this time of the year. It's so hard to fight that $7-8 billion daily buyback that's coming into this market. The flows are very structurally supportive still through the end of the year. So while I think that today's trading session is really interesting, and if you were counting on an end of the year rally, today's trading session has to make you take pause on that thought process because we broke through some key technical levels. But I still struggle to turn into like a full on bear here into this November December period, just because of the supportive structure of this market. Now, with that said, different flows, right? Different flows can overwhelm other flows. And if we can start to really trigger on a closing basis this CTA sell trigger that we have not been able to do, we ticked below it briefly back here on November 7th. We ticked below it, I think, super briefly back here on October 10th, maybe. Or maybe even we didn't even do that. We definitely traded below it but closed above it back here on November 7th. If we could start to get a real close beneath 6,700, all of a sudden things might get interesting because then you might start getting a whole additional flow on top of it. If the volatility stays high, the movements stay high, if we start losing 6,700, we start getting the CTA trigger, then yeah, you'll still have the corporate buyback bid coming in to buy $8 billion a day, cushioning the downside, but it'll be doing that into the face of increased selling coming from vol control and coming from the CTAs. So a little bit of a battle of the flows if we can get below that level. Turning things back over to the indexes, though, I want to keep in mind that bigger picture, it's probably still a little bit of a buy the dip environment, especially if you can get into more extreme downside extension. On, was that Friday last week? Yeah, Friday last week, when we had that big downside tail, the low of the day there was at, some real extreme downside extension. On the SPYs, looks like we were like $14 extended from the ADMA on the daily, and the Qs, it looks like we were almost $20 extended from the ADMA on the daily chart. So, if I see that we are getting into like that deeper day 2 extreme extension or day 3 gap down extreme extension, that's where I'm interested in buying shorter term dips for more than day trades. For now, I actually did a lot of day trading today. I've been doing a lot more day trading this month, like pure scalpy type shorter term day trading than I typically do. A lot of what I do is a little bit bigger picture where I heavily manage those positions intraday for cash flow. And in this environment recently, I've been, being a little bit more flexible with some of the day trading stuff. So, yeah, I mean, that's kind of my continued thought process is in order for me to take some longs on that are going to last more than just a half an hour or whatever, I want to see that like very deep day 2 extension, somewhat similar to what we had last Friday. Tomorrow's a Friday again, by the way. And, maybe even that day 3 kind of gap down situation. It's been really interesting, this pattern of the market with these like, I think someone posted into the VTF a certain point at like a Michael Burry tweet that maybe he tweeted today about, hey, the market's smoked, but it's a Thursday, and this is what happens on Thursdays. This is what happened last Thursday. Fridays have tended to be weak, and if I remember correctly, we have not seen a red Monday since August. Really, really strange, these weekly patterns that we're seeing, and we see those pop up from time to time, but they tend to not last. But for the moment, it has really been that way. Tons of strength on Monday, tons of weakness into the end of the week. I have put a lot of that on headlines that have come out of the administration. I've noticed a pattern where the administration likes to announce bad news or threats or whatever on Fridays, and on Sunday nights they like to come out with stuff that's really positive or reverse the negative thing that they had just said on Friday in order to get the market to move back up. And I think that's what's attributed to a lot of this pattern that we've been seeing. But at a certain point, into a certain degree of weakness with those 4.5 or 10 points that we're talking about on the reason why to be bearish, I think that they run out of things that they can do at the administrative level to do or say things unless we lose tariffs. We're still waiting to see on the tariff situation. That'll be an interesting one. I don't want to get too off topic, but I think that like the most ideal situation for markets and the economy would be if the judges say that they can't continue to do these tariffs, but only on a go-forward basis. So we lose the economic destruction that tariffs have caused going forward, but we don't give back the money that we've already taken in. I just think that giving back the money that we've already taken in is going to be a complete and utter shit show if we have to do that. And it's really, really interesting to see. I don't know if you guys have been following this, and this is probably the reason I'm even bringing it up. I think it's just in my head. The market that's ongoing right now for like, the secondary market for like tariff claims, where a lot of these banks, I've heard Cantor Fitzgerald is one of the biggest ones that's out there that's doing this, but there's other players too who are going around and offering companies who, the importing companies who are the ones who pay the tariff on the way in, and offering them whatever 30 cents on the dollar for the claim on the tariff that they've paid, with the idea being that if the judges say that the tariff money has to get paid back retroactively, those companies are taking a bet where they're paying 30 cents on the dollar and they can recoup the entire thing. And the companies that paid the tariffs are probably happy to be able to get any money because so far it's just been an outright loss to them. So it's really interesting to see that secondary market is ongoing with tariffs. But I think that the absolute best situation for markets would be if we can get rid of tariffs going forward, but not actually get rid of it retroactively, just because it's just an insane headache to give that money back at this point, in my opinion. Anyway, kind of getting off topic, I think that we have discussed to death at this point the reasons why the market should go down, with the market dynamics that should hold us up. The update of today is that we had a very weak trading session and we lost some major support levels. So SPYs, not only did they lose 680, but they lost 674 at the same time. So SPYs have gone from full out bullish to full out neutral as far as I'm concerned. The Qs, which never really got back to full out bullish because we never got above 625, went from like neutral bullish to neutral. And this IWM is borderline going from neutral to bearish. I would argue it's gone from neutral to bearish neutral. And if we can really kind of crack further through this like 236 to 238 area, we did close below 238 today, then this actually starts to turn full outright bearish as the uptrend turns into a downtrend with a high, a low, a lower high, and then a subsequent lower low. So you'd actually would have a full-on technical reversal in the IWM at that point. The Qs, that could happen too, but the Qs, I need to see them, really get below last Friday's low, or honestly, even more ideally, get below the October 10th low, in my mind, for them to turn full-on bearish. So for the moment, they're neutral. And I guess that is the technical update on today. As far as intraday trading goes, guys, pat on the back. We're definitely not always perfect. I know I'm not always perfect, and I like to talk about when we're both wrong and when we're right. To keep us even. I think that the calls today were just absolutely on point. Gap down, followed by 15 minutes of downside selling to create a lot of downside extension on the small time frame. We called for the long, right here into that original pivot low for the snapback to the 80 EMA. It overshot it. We called for the short at highs for the 15-minute correction for the SPYs and the Qs. Let's give credit where it's due, but not overdo it, right? Because when I called for that short, I thought it was meant to be just a cuter, quick short trade, maybe a snapback to like 679. I had felt that the bounce back went too far for us to really make new lows on the day. Obviously, I was wrong on that, but it was still a really good short call out. And that's why it always pays. I'm a big advocate of holding a little percentage of your position just in case that retracement that you were looking for becomes more. But, we called out the long, we called out the short. Somewhere in here, I think right here, actually, we called out for another long. as the market was approaching the SPX. No, I can't remember the number. It was 6770. As we were approaching that 6770, we were looking for that to get supported because of the large gamma that was in that area. So when the market got into that, it was the same thing. Quick long trade here for snapback to the 80 MA on the 5-minute. Another great trade. And then, from there, I personally didn't like the idea of pushing further to the short side. I kind of felt that the combination of that large positive gamma plus the structural positive things of the market we're going to make it so that we would end up kind of chopping sideways here, or maybe even rolling back up, as this market has had such a habit of doing. So that's kind of where I was wrong. I did not push this bear flag further to the short side. You could have done that and made more money for yourself. I definitely got out of the way on the long side, though, after a couple quick scalps on those call outs, and then wasn't looking long again until we were working our way back towards this low for a little bit of a bounce. And I think I had another call somewhere in here that was a little bit too early that didn't work out. But overall, whole ton of great calls at the index level, some great calls on the individual stock level, as long as you didn't overstay your welcome and you weren't too greedy. Oracle 220, big support on the daily chart. That first buy on Oracle 220 was pretty good. I missed the second one. Was upset about myself with it because that one worked even better. But again, kind of quicker trade there. In Oracle, I got fully out of it into this up move on what I still had. I pieced back in small into the down move, got out into the close for a little bit of a profitable trade. Nvidia was another one that we bought this dip on the third 5-minute bar down. Some of you guys might have started a little bit too early. My timing was pretty good on it, but same deal, out of that trade relatively quickly. Just kind of some quicker scalpier trades, and some great call outs intraday for some day trading on some of those names and at the market level, which was awesome. Bigger picture, we reached my initial $25 target in RGTI. Got out of my RGTI at $25 to the short side. Definitely got to give myself a pat on the back on this one. I've been talking about this one constantly, about not just making the money from the short from 54 down to 42, but continuing to pound this on the wedge breakdowns, on the support breakdowns for the continuation on a company that's got $1.5 million in revenue and a $10 billion market cap. These can still go lower, but at this point, as they extend into my targets, I'm good for now. I'm out, and we'll reassess these. I might even, if we could get another real down day in these things, I might actually take these long for a short trade at a certain point. I probably wouldn't look to do that until at least 22 with RGTI, and it would definitely be a shorter term trade. Honestly, what I would prefer is don't even let me in that trade. Bounce this thing back up to 29 to 32, and I'll probably be re-entering the short into that area on the RGTI. But QBTS, same thing. $25 was my target. I was out of that one really early this morning. It continued beyond that. If this gets into 20 tomorrow, I might look for that oversold bounce trade to come in. But otherwise, I would prefer for this just to bounce so I can look to reshort it. OKLO, we're continuing to push this. Let us back in on the snapback on the earnings yesterday, but faded right off this 80 MA, creating another pivot high. I'm still in this. I needed to lose the support at 100. It hasn't done that yet, but I love the idea of just continuing to push these types of names. They continue to get wrecked as the crypto situation gets wrecked too. Anything like I was saying the other day where there's just no value is actually getting hit a little bit. I mean, today though they started to hit everything a little bit more, and really they started to hit Mag 7 yesterday. Nvidia 180 is a huge support level, so we'll pay attention to that one if it gets down there. Meta was actually relatively strong today, but I think that's just because it's so extended to the downside on the daily chart. Apple still somewhat acted as a safety play today. You can see, if you look at the 5-minute chart on Apple, just all types of relative strength, trying to once again get bought up as they sell AI in the beginning of the day, weakening out a little bit, but giving really big snapback rallies at various points throughout the day compared to what the Qs were able to muster up insofar as bounces go. So yeah, just I think it was a pretty solid day today with some really good calls, and I don't really have anything else to say. So happy to turn it over to you guys for questions. Let me see what let me see what Bill's posting here. Perhaps most importantly, people are starting to get the joke on the impact of leveraged ETFs being such a massive force in the current market structure, where it's the synthetic negative gamma from the retail proxy leveraged ETF positioning, which is then implying maybe the worst flow, hence being front run with end of day rebalance carnage currently estimated to be at $17 billion. So, in English, these levered ETFs into up days they need to buy, into down days they need to sell. We had seen a chart from Nomura, which maybe isn't actually in Bill's second post here, that was showing that per 1% move in the S&P, there's about a $7 billion rebalance. So it looks like there was set to be 17 billion of selling from that gamma situation. Yeah, it looks like it's the same thing here. Mega cap tech, AI, MagX centric levered ETFs now an additional source of $7 billion per 1% move of synthetic negative gamma. The lower we bleed out, where we estimate 17 billion of end of day selling on the rebalance. It's incredible, and there's so much assets under management now with these levered ETFs that this is interesting actually, because of what it does to this market when you think about the impact here. What levered ETFs are going to do is, when we get these very, very large moves, it's going to stretch very large moves even further than what happened normally, right? When you think about counter trend trading as an example, which is something that we do here, and we try to time extreme extension with shorting on the way down of extreme upside extension, or buying on the way up after multiple down bars, and the 5-minute RDR trade that we look for, or the daily RDR trade that we look for. When you think about any sort of counter trend trading that you're doing, you've got to keep in mind that the fact that levered ETFs exist at the index level and for individual stocks, it means that, like, I was actually trying to describe this to my wife somewhat recently. I don't even remember why we were talking about the stock market, but I was trying to describe it using comparisons in layman's terms that someone who is not doing this day to day would kind of understand about how markets work. And I was just describing markets acting as like a rubber band, where at a certain point you stretch a rubber band as far as, like, pretty far, it's gonna force it to kind of come back together. And what these levered ETFs are enabling that rubber band to do is stretch significantly further than they would be otherwise. But like anything else, and I'm seeing what Bill is saying here, this is a potential edge for us also to recognize that, hey, into these really big up days, into these really big down days, you're creating something that feeds on itself, especially when you think about all the different flows. I think that this is a little bit of what happened on Monday last week. I think it was Monday this week, where we were set for a really big vol control bid, which boosted us in the beginning of the day, but the vol control bid would stop at 1.5% higher, but we continued to move up. And that was because into that same 1.5% move higher, you're now also expecting like a $11 billion ETF leverage rebalance buy that people are front running, and it's pushing the market even further to the upside. And that was why, by the way, and now the market's come back down. If you guys remember on Tuesday, which was Veterans Day, I was saying, guys, I really want to pay attention to see if the SPYs can actually hold above 680, and that it wasn't just a consequence of vol control feeding into leveraged ETF rebalancing that's enabling us to hold up here. And then we got, two decent closes in a row above 680, where I was like, okay, that settles it. The bulls are actually back in control. And now we almost had the exact same thing happen to the opposite side, but I think it can be even more violent on the downside, because when you are thinking about the up day that we had on Monday, sure, you have vol control buying that can occur on Monday between like flat and up 1%, but then you lose it. In big down moves, with how we're structured right now, you get increased vol control selling the more we go down, larger percentage we're down. And on top of that, we get increased leveraged ETF rebalancing sell flows at the same time, where both of those things are hitting at once that can really extend this market further to the downside. Given that, I think that we need to be really careful on, like, I still think that bigger picture, there's going to be some insulation to this market and that dips are buyable in this market. But I think it can make it so that you could very, very easily be too early, where you might look and say, tomorrow, we're $10 extended in the SPYs, and the Qs, I think, they're $9 extended at the close even today, or even after hours where we bounced a little bit. I think you got to be really careful if you see that we're down like 1.5% tomorrow or 2% tomorrow, saying, all right, we're down 2%, so I'm just going to go max BP long for the dip buy because we're $15, $12, whatever of extension to the downside, and I know that there's some structural support, but then you're getting run over just by this additional force selling that's coming in from these leverage ETF rebalance flows, to the point where it's almost going to be better if you wait for the following day, because by the following day you have the chance for those things to reset and the market can be trading closer to flat without the forced selling that's coming in, and maybe there's even forced buying that's coming in from the corporate buybacks, or maybe vol control needs to buy on that day in an unchanged market, or what have you. Really interesting stuff. Thanks for posting that, Bill. Jerry had some questions. Can you describe more fully what you generally refer to as short-term tactical? Yes. So short-term tactical is just an indicator that we get. It's usually in Pat's note. Pat is on vacation this week, so I have been posting it into the virtual trading floor as long as I can get it, which I have been. I've been posting it just into the virtual trading floor, copy paste in the pre-market. But let me pull up the last Pat note I have, which is from Friday last week, and see if it was in it. Yeah, there it is. Here we go. So all short-term tactical is this thing right here, this multicolored little thing with this black arrow in it, which indicates where you're sitting. And basically it's just a measurement, and I honestly don't know how it's derived, but I've been looking at it long enough, because it's been Pat's note for years, that I understand how to use it as a tool. And basically it just indicates, it's another indicator of overbought, oversold conditions in the market. And when you are in the yellow or orange zone, it means that things are pretty neutral, there's no advantage. When you're in the green zone, it means that you're oversold. When you're in the red zone, it means that you're overbought. The way that I like to use short-term tactical is that if we're in the green zone, it does not mean buy. The green zone means to me, don't short. You got a bad risk reward because of the amount of downside extension we have of putting on new shorts if short-term tactical is in the green zone. Short-term tactical is in the red zone doesn't mean to me short. It means to me don't buy. You got a really bad risk reward of pushing new longs if short-term tactical is in the red zone. Sometimes we see multiple days in a row in a bigger market crash, for lack of a better term, or a bigger upside squeeze in the market. Sometimes you will see multiple days in a row of short-term tacticals sitting in the green or red. It is very rare to see short-term tacticals sit in an extreme zone for more than 3 days. Seeing it happen for 1 day, 2 days is relatively common. Once in a while you get 3. More than 3 days becomes very rare. I've only seen it happen, a couple of times. Definitely happened back in April on the green side. It was more than 3 days in a row at a certain point when the market was just having an epic sell-off. But it's very, very rare. So when I see short-term tactical be in an extreme zone for 3 days, then I actually do typically begin to use it as a counter signal. So instead of short-term tactical sitting in the green meaning to me, not just don't short doesn't mean buy, it means don't short. If I see that it's in there for 3 days in a row, not only does it still mean don't short, but then I'm starting to say, all right, I probably should really be looking to buy this. And usually that's going to correspond with the way that I view extension at the index level with the measurements from the ADMA on the daily chart. But that's all a short-term tactical is. It's an indicator that we pay attention to that gets updated daily. It's a little bit different from short-term composite, which Pat also gets into the note. Short-term composite, they say, is a counter-trend signal, I believe, below 10 and above 90. When you're between 10 and 20, it probably means, like, same thing, like, don't short, not necessarily to buy. When you get below 10, sometimes it means that you can, really look to start to buy here. You can see in March at one point in April at one point into the extreme insanity, it went to 0. And then same thing above 80 and above 90 on the upside. Short-term composite is more based on the average stock that's out there. So I think the RSP, think the IWM. The short-term tactical is more based on the S&P and the Nasdaq. So a little bit more market weighted there. So that's what I mean when I'm saying short-term tactical, like in the morning meeting. From Jerry, second unrelated question. I never hear you refer to a measured move. I say it sometimes. However, I hear a lot of other traders refer to it. Could you explain your view? Sure. So measured move can mean a few things in a few circumstances. Very simply put, in technical analysis, chart patterns will have measured moves. So if you've got a bull flag or a bull wedge that's breaking, whatever, they have measured moves. A head and shoulders pattern has a measured move, right? Doubling the head to the neckline on the break is what you're expecting the measured technical pattern move to be. Most of the time in the VTF, though, we're not really talking about measured moves from technical patterns. We're talking about measured moves from the options market. So, and measured move is technically the wrong word. I think it really should be implied move from the options market. But, tomato, tomato, I guess, to some degree. So if you hear anyone in the VTF, and I do this myself, talk about the measured move of an earnings report, it's just referring to what the options are pricing in. And basically the way that number is derived is if you take the nearest strike, call, and put, and you add them together. So let me try to give you an example here. Let's say that NVIDIA was reporting earnings tonight, right? So here's my options market maker here for NVIDIA. So NVIDIA is trading at 180. It closed near 187 today. The closest strike is 187.50. So tomorrow's expiration for the 187.50 is trading at about $1.90 for the call, and on the put it's trading at, let's just call it $2.40. So we would say that the implied move or the measured move of what you would expect NVIDIA to do on its earnings report is adding the price of the call and the put together. So $1.90 plus $2.40 becomes your measured move. So whatever that is, is your measured move. So that's what that means. You're just adding those together and you come with measured move. But you can also do that, like you could do that for the S&P on like a 0 DTE to understand, what the implied move is for the day, for the market as well. Similar but different to when you hear Bill Kay talk about like the option straddle for the SPX, kind of like little bit of like what the expected potential move is from the market, what people are pricing in. So that's what that means. Hope it helps. Robert. So judges literally says can cancel all tariffs for all countries. Isn't that in the hands of leading government as major economic decision? So let me try to give you some background, and I'll do my best to be unbiased as possible. But you guys know how I feel about tariffs, so it's difficult for me to do that. The idea here is so traditionally, the power of levying tariffs against other countries comes from Congress. So it is not a presidential power. It is a legislative power, not an executive power. So the president of the United States is not supposed to be the one who has the power to put tariffs on other countries. It's supposed to be Congress making those decisions. Now, President Trump, he likes to use loopholes and transform the law around his will. I guess I'm going to try to be unbiased on this one as best as I possibly can. But, you know, there are situations where, like in war or something like that, or if there is an extreme, I'm trying to remember the exact terms around the specific statute that Trump has been using to levy the tariffs against other countries as he's been doing. But basically it calls for like, I don't know if anybody here in the VTF knows the exact language, but basically it calls for like, to like, if the president has the power to levy tariffs in like an extreme situation where he has to protect the country, but it's really meant more, I think, for like a wartime situation than anything else. But Trump extended that to mean, oh, these other countries are taking advantage of us because there's a trade imbalance, and therefore I can use this executive power to be able to put tariffs on and override the fact that it's supposed to actually come from Congress. So naturally what eventually has happened here, which happens a lot with this administration, is people will say, hey, you don't have the power to actually do this. We're not in war. You can't extrapolate the language around this cause to say that you can just put tariffs on anybody because they act as a tax against U.S. citizens and only Congress can choose those taxes. You don't have this power. So the judicial branch in the United States, right? You've got the executive branch, it's like the president, the legislative branch, it's Congress and the Senate, and you've got the judicial branch, which is the judge and the jury and all that fun stuff. The judicial branch then is the one who, if there is a kind of battle of power, I guess, between like Congress and the president in this case, it goes to the judicial branch to interpret the law, because that's what they do. The judges interpret the law to decide whether or not the tariffs that Trump has implemented were done legally or illegally, whether or not he stretched the meaning of this clause to, to beyond what it is intended, and is taking away power from Congress and the Senate that traditionally is supposed to belong to them. So if they sue basically to say, hey, you can't actually do this, now it's up to the judges to basically come in and say, hey, the judges are either going to say, hey, we have decided that this is not the way that this statute is supposed to be used. The executive branch, Donald Trump, the presidency, does not have the power to levy these tariffs. Therefore, it was done illegally. Therefore, it is taken away. We're taking away that power. You can't do that. Now, if you've been following along with this, and I think if you follow along with like a Kalshi or a Polymarket, the starting probability of the judges taking away this tariff power from the president started pretty low, and it's been increasing. The little bits that I've watched and heard and listened to and read about of the trial as it's ongoing, the lawyers that are representing like Trump and the executive branch are not doing a good job making the case based on the questions that are being asked of them. And you're seeing in the odds market from Kalshi and Polymarket or whatever a increasing probability over time recently that the judicial branch is actually going to say, hey, this is illegal. Now, the real question, the bigger question in some ways is, I guess it's not the bigger question. That's a really important question, whether they make it illegal or not. But the secondary question is, if the judicial branch decides, hey, you did this illegally, you can't do this, what are the consequences of that? Are those consequences, A, he just can't do it anymore, or he has to find a different statute? Again, you know, there's a lot of different laws out there, and when this was first brought up, let me see if I can even find this in the market. I don't even remember how long ago it was. This was first brought up months ago, that Trump maybe is using like a methodology for enacting tariffs that is stretching the law too far, and he might lose that. At that time, we had read analyst notes that there are other statutes that are out there that Trump can use instead. I don't remember what they are. So there's a whole number of questions here that are unanswered, and therefore a degree of uncertainty, and markets don't like uncertainty. Question 1. What is the judicial branch going to decide? Did Trump overextend his power and he can't use that statute to put on new tariffs? Yes or no? If the judicial branch says he's allowed to do it, then it's the status quo of what's already been going on this year, and he'll continue to do it. If they say he can't do it, that then leads to several other questions. Question number 1, does the Trump administration have other statutes in their back pocket that they can use to just levy tariffs going forward in the exact same way, but doing it a little bit differently? Question number 2 is, if they view it illegally, as if this was done illegally, does that just mean that he can't use tariffs further going forward, so the tariffs are all just gone? Or does it mean that in addition to that, he has to pay back the tariffs that had already been collected because it had been done illegally? And then honestly, question like subpoint B would be, if the judicial branch says that they have to pay it back, does he just ignore the judicial branch and not pay it back anyway? Which, you know, might happen. But that's why you have this secondary trading market ongoing right now for claims against tariffs. You know, I mean, I'll ask you guys this, right? Like, I mean, you got to do your own research on it, but like, if I could offer you $100 worth of tariff claims for $5, are you a buyer? Meaning, you are going to spend $5 right now, and if the judicial branch decides that what Trump did is illegal and they have to pay it back, you're going to get $100. But if they decide that it's not illegal, or it is illegal but they don't have to pay it back, you're going to get $0. Are you a buyer at $5? Are you a buyer at $10? Are you a buyer at $30? Are you a buyer at $50? Where on the scale of the marketplace are you willing to come in and be able to buy those? I would probably be a buyer at $5, but I certainly wouldn't be a buyer at $50. That's kind of where my head's at on the probability of I guess those things actually getting paid back. So yeah, it'll be really interesting. Thanks for the question, Robert. From Matthew on SanDisk. SanDisk, support and resistance at the current level 245, stop level for shorts. Sure. So target number 1 for me would be the 80 EMA on the daily chart, which I got to today. The bigger target that I like on this is 220. It's a previous resistance level, it's a future support level, and it's like the midpoint between the 8 and 21 EMA. I would, if it gets to 220, I would not get all out, to be honest. I would hold some for a bigger move maybe down to like $200 on this. Maybe even a little bit more than that, maybe even 190. So that's some targets. As far as stops go, it I, for now I would honestly probably still be using the same stop if I was swinging it, the same stop that I was originally using when I got into it, because there's been no lower high on this daily chart. I have no way to trail this. So I would just be using my same original stop for the moment until more data presents itself and I can potentially lower it. So, hope that helps. A bunch of companies are preparing bids for Warner Brothers. I don't know why. Makes sense for Paramount, I guess. The recent wealth tax increase in Norway was expected to bring in an additional 146 million in yearly tax revenue. Instead, individuals worth 54 billion left the country, leading to a loss of 594 in yearly wealth tax revenue. Interesting. It's really interesting. At a certain point, right? There is a number. From Vincent, can you go over volume where you said you watch for volume in certain areas? Sure. So, you know, I'll tell you the way that I've always viewed volume in trading, and there are definitely people that are out there who get much more in depth into volume strategies than I do. And I had mentioned Robert earlier, and I'm not sure if you were able to chat with Robert in the VTF at all, but I know that at a certain point, I don't know if he's still doing it, Robert was looking into some deeper strategies related to volume that are a little bit beyond how I use it or how I have used it previously. But the first thing I would say about an increase in volume in any stock at any point is we consider that, we call that confirming, right? Volume confirms what you're seeing in a chart, but price action can happen without volume, right? So you can get a bull flag, and that bull flag can break out with no change in the volume pattern, and it can work. But if you get a bull flag that has the appropriate volume pattern, most technical patterns have a volume pattern associated with it, you're going to have a higher probability of success than if the volume's not there, right? So volume's supposed to maximize in the flagpole, get reduced in the flag itself, and then increase again in the breakout. Or, and that's just an example of like a volume pattern with a technical chart setup, a technical pattern. I like to see, and I don't know if I have any good examples from today. I can look around on 5-minute charts, but I like to see, like, when I'm going to take an extension long somewhere, like the market is extending down, and this is perfectly an example of what I don't want to see, but it still worked. So it actually goes back to what I was just talking about how trades can work without the volume confirmation, but you've got an even higher probability when you do. Like when I was calling for the long here at 9:45, I want to see actually this candle have more volume than the others around it to confirm that something's happening at this more capitulatory pivot low for the bounce. That's what I want to see. The trade, as it did, can work without the volume increase, but it would be a higher probability on that snapback trade if there was higher volume, coming in basically at that extension pivot point. So that would be confirmation to me that volume is increasing at a certain level. If you see a breakout or a breakdown through a level, you want to see that happen on like really high volume. This Tesla is tough to read here, but this second bar here actually has pretty damn good volume on the break of 420 here. So you want to see like breakouts and breakdowns be confirmed by higher volume as well. Another thing to pay attention to is consistently higher volume than normal. That is an indication that you're going to get wider, bigger moves from stocks than you would in a normal situation. When you see that a trade, a stock is really moving higher or moving lower, and you're thinking about like a counter trend trade, and you see that volume is very, very, very consistently large, you got to be extra careful about that counter trend trade because there's something going on, and that's why the volume is so much bigger than usual. You can just see, Tesla yesterday had a fairly normal day, some heavier volume in the beginning that got lesser throughout the day, but just look at how much bigger the volume was over the course of the first 30 minutes, first hour, compared to how big it was compared to the first 30 minutes, first hour yesterday. This volume here was really confirming that something was going on in Tesla that can lead to continuation, and that, so a statistic that traders look at that I don't look at, I don't like to look at it, is average true range. It shows you how far, how big a range is on average over the course of the last 3 months for a stock. I don't like to look at average true range because I think it messes me up more than anything, where a stock moves $1 in a typical day and now it just moved $1, and I'm like, oh, I need to get out because it just moved the average true range. But then today is the day when it moves $3, and I got out because it moved the average true range. So I don't like to look at that statistic, but if you can see very consistently large volume, that's going to tend to be the day where you get moves in the stock that are much bigger than the average, much bigger than that average true range. And that certainly applied for Tesla today, right? Tesla, I'm assuming this is bigger than the average true range. We got, a $30 down day from lows to highs in Tesla, and the volume was very, very, very consistently large compared to usual. So that's how I use it. And yeah, I see Robert here already giving you some feedback, which is great. Awesome team here. So he looks at things, I think, a little bit differently than I do, a little bit more depth than I do, and that might be able to help you also. From Jim, I have at least a few days a year like today where I'm caught in a name that's liquidating. Today it was Tesla. I'm taking trades at predefined levels. When the volume picks up, I get greedier because I'm assuming there will be more buyers stepping in, and snapback is more likely to happen. It's almost like we're just combining two volume techniques at the same time here that we're just talking about, right? Let me hold that thought and read more of what you're saying. After stopping out a few times, price moves lower, and I get even bigger because theoretically I'm going to trade at an even better price if it's lower, and then I get caught with my biggest size in a spot that quickly gets pushed through to the downside and take a much bigger loss than planned for. I'm assuming you've done this before and curious how you handle it moving forward. This is the biggest missing piece of my puzzle. Sure. So this is a great question that you have because it corresponds really well with Vincent's question that we just had and we were just talking about. It sounds to me like so two things. One, you gotta be extra careful about counter trend trades in a stock that is showing consistently much higher volume than it normally does. So that's one. Now, what you're describing is a little bit of what I was just describing with the SPYs in the situation where it's not a good example because we didn't actually have the bigger volume come in on the pivot, where you are looking at a counter trend move. You want that counter trend move to be confirmed at important spots, at extension and important levels by larger volume coming in to say, hey, I can come in and take the counter trend trade in the exact same way that I was just describing with the SPYs, how I want to take this counter trend trade and I would love it to have volume confirmation because that's the signal that the bigger volume means that that trade can be an even better trade. So it's kind of the two things at once. Like, I think that the ideal situation when you're looking at the counter trend stuff as opposed to like the full out liquidation event that you're describing is something that's trading on relatively normal overall volume, but then you get the volume spike at the acceleration point, at the support level, at the pivot point, and then you're taking that trade counter trend, versus when you see that very, very, very consistently larger volume that indicates that something else is going on here that's creating a momentum move, liquidation event on the downside, gamma squeeze on the upside as well, where you try to come in on that counter trend trade and you're consistently you're just too early, you're too heavy, you get heavier, everything that you're describing, and it's because that volume is just so much bigger. So that's the first probably biggest thing that I would say about that, and that has been something that I actually have really been working on with my own trading recently, because I've run into that problem as well, and it's happened a few times this year where I've been in the exact same situation that you're describing. And I remember you've probably heard Brant be upset about shorting on this day here in Palantir. Like, I think him and Robel were chatting in the VTF like a day or so ago, probably yesterday when he was getting hit down. He was like, man, don't you remember when we were trying to short Palantir, back on, I guess that was Monday, and this thing wouldn't give us 10 cents to the downside, and now look at it, it won't stop crashing. I remember on Monday watching those guys, communicating about the trade, and I think I said I was like, guys, I would move on from this name, and the reason why I said that is because Palantir was exhibiting those characteristics that you're describing, which are the same characteristics that Tesla was doing today. It was just super relatively strong with. You almost can't see it in this daily chart now. Let me see if we can actually confirm what I'm saying in the 5-minute chart. But yeah, look at the beginning of the day on Palantir on the day that it squeezed. Like, this volume here, this first hour is, look, especially compared to the next day, right? Like, these next couple days are probably a little bit more typical. The day before is a little bit elevated, but not as elevated. But I remember watching this as these guys were looking for like counter trend trades, probably as it was getting into like 190 or 191, something like that. And they were struggling with it and entering it and stopped out. And I'm looking at this thing and I'm like, guys, it's the most relatively strong stock and the volume is very, very, very consistent. That indicates that you are going to get that outsized overall move compared to the ATR, and that's when these things continue, and that's when those trades become particularly difficult. So I've learned this lesson myself over the course of some trades this year where I was on the wrong side of that stuff, and I have been actively trying to avoid being involved in shorting Palantir on that day or buying Tesla on a day like today, unless it's like a real short-term scalp and I'm stopping myself out real quick on that if I'm wrong. You gotta, if you're gonna take that trade, okay, fine. The volume is really consistent, but at a certain point, there's a bounce here, right? So if you can get that confirmation that you're looking for, and you say, all right, I'm recognizing the overall volume, I'm recognizing everything that's happening here and that it can continue because the volume is so big, but I have a little bit of a signal and I'm gonna go for it. I think that you've got to have a hard stop in that situation. Like, I'm going to put a hard stop out in that situation because, again, it's these liquidation events, these consistently large volume events, is when these things just go and go and go and go and go. And, in fact, I want to try to take the flip side out of all this. It's tricky sometimes because in these situations, they don't give you the entry to short. And in Palantir on that day, they didn't give you the entry really to buy, but I would also go as so far as to say, like, so for me, I'm doing a better job of not buying Tesla today, not shorting Palantir on that day. The next step, not only do I need to do a better job of avoiding counter trend trades in names where the volume is very, very consistently large, but I should do a better job of being a momentum trader in the direction in which they're moving. Which, look, guys, this is the awesome thing about trading. I've been doing this for 15 years, and every single year that I've been doing this, I have been able to make more progress as a trader and improve. These are some examples of my own improvement over the course of this year, right? One of them I've been talking about a lot lately. It's in these RGTI situation, not just being out at 42 and continuing to push that. And two, it's progress in not going counter trend in names that have the consistently larger volume. And now I'd like to think that the next step would be that I can even try to work on my momentum trading, harness my inner Judy a little bit more, and maybe try to find entries to be able to buy that Palantir or short that Tesla just more on pure momentum, which I've always been uncomfortable with because I like to have that confirmation by the it was complimentary, Judy. I like to have that confirmation that the stock's not too extended with the ADMA catch up and all that stuff, which inherently means that I'm not really taking as much of those pure momentum trades where I'm really buying things that are running because they can probably run even further, or in the case of Tesla today, maybe shorting something that's running to the downside because it can fall through the floor even further, because that momentum is there and that consistent volume is there. Like that would be a further progression for my own trading that I can work on. So I hope that helps. Tesla was of interest to me because I was looking at it as a stop hunt at the low of the range to get long for swing continuation. I think ultimately I just got too big because I looked at it as an A plus level. Sure. Yep. No problem. Did not use stops today. Had dog training here. Judy was very bad. Don't be bad. Alright, what did I miss here? Scrolling up in the VTF. See if I missed anything. Alright, looks like we kind of covered it there. It's getting late. Let me see if I missed anything in the YouTube. From Apex Joy, can stocks like ACN, Apple be contrarian play when the market is overextended to the downside and start shooting them up, and long NVIDIA, etc.? I'm not sure about ACN. I'll be honest. I really don't. I don't follow this name. This daily chart in ACN looks very different from the daily chart in Apple. This is building out like it's either a giant base or a giant bear flag. Only time will tell. Apple, I have been following much more closely. Apple is interesting because it has been acting. I don't like the term contrarian play there, but it's been acting as a safety play. Where when they're selling AI, when they're selling NVIDIA, they've been holding up Apple, they've been buying up Apple, sometimes Apple's even green. So you can look for that. It kind of just depends on what stage of a bear market you're in. We're not in a bear market at all, but what stage of a weaker market or a selling market we're in. In the early stages of a market that shows weakness, they will sell things that are riskier or more speculative or that have the bad news, and they'll rotate that money into things that are perceived as safety plays. That might be Apple, that might be treasuries, that might be the dollar. But eventually, if you get deeper into a bear market, deeper into that cycle, then that loses that case. They start to sell everything together and correlations increase. So for now, the answer is yes. You could have been looking for longs in Apple today just because it was trading so much more relatively strong to everything else as the Qs were getting destroyed. And then it almost sounds like you're asking about like second level thought process in regards to, well, what about when NVIDIA finally looks like a long? Should I then be shorting Apple? That's a little bit too tricky for me. So I'm not going to do that. It's just a little too much. I hope that helps. All right, everybody. Have a great night. See you all tomorrow. Great job today, team. Keep up the good teamwork.